In this lesson, we're going to talk about the next sort of major half of all adjustments, which are allocations. So once again, you need to sort of have this web page note open, and you're going to need to read through it as well at a later date. And you want to stop this video as we get to some of our learning activities and try them first, and then have me take them up as the video progresses, right? While you've got both this note open, this one here, and the exercise as well. And the learning video for what we're going to talk about today is exercise 25. Or sorry, not the learning video, the learning exercise. So let's jump into it. We're in now, we've done accruals. We're going to talk about allocations and amortization. And we're going to talk about three types: bad debt, supplies, and then two types or two ways to amortize things. So let's talk about what exactly does it mean when we say allocation. And I mentioned it quick when I introduced adjustments, but I want to expand a bit on it. An allocation, as it says, is the conversion of asset value into expense. And it's done, again, for that purpose of accounting, to provide useful information for decision making. It's done to make sure that the accounting records have all the expense in the accounting period possible, and so that they reflect what's actually happening, right? So that the information is useful. And when you use your long-term assets, they wear out, right? So if you're not doing anything, this is just an example, right? This is actually what amortization is. If you're not doing anything to show the wear and tear on your assets, then you're actually probably showing more profit or less cost and expense and less erosion of your equity and your wealth than what's actually happening in the accounting period. And that's the reason these things happen. So let's jump into our first one, bad debt. We're only going to do these two in this lesson. Bad debt is essentially what it says. It's not your bad debt, but it's someone else's bad debt. In other words, you've sold something to someone on credit and they're not going to pay you. And that's just part and parcel of selling to people on credit. If you want more customers, some of them are going to need time to pay. So if you allow your business to sell things on credit, some people are going to stiff you. You're just not going to get paid every single cent. It's just the way it works. And to tell people who look at your financial statements how much you're legally, entitled to be paid, how much your accounts receivable is, how much you're owed, and then pretend that you're going to get all of it is misleading. It's false, because you won't. You never get all of it. And sometimes people stiff you on purpose, and sometimes it just go bankrupt or things happen. But you'll never get all of it all of the time. So bad debt then is a two-step process. And the first thing you have to do, and we'll go through both of them, the first is you have to do what's called making the allowance. And this is where the expense occurs. And the second step, which can occur many, many, many years later, is when you actually erase the accounts receivable that's bad. That's delinquent is an expression. In other words, that it's uncollectible. When you're certain, you can do step two. And there's three accounts associated with this adjustment process. The first is accounts receivable, which you already know about, right? That's a current asset. But the next is a contra account. And you should already know what contra accounts are. They're things like sales discounts, purchase discounts, HST recoverable, so on. So the allowance for doubtful accounts is the account that's married to accounts receivable. So accounts receivable has a debit balance because it's a current asset. And the allowance account has a credit balance because it's contrary to accounts receivable. And the two of them sum up to be what's called the net realizable value of your accounts receivable. And that essentially means the book value of your accounts receivable, how much you expect to actually get out of the total you are legally owed. And the third account is the expense. So when you make the allowance and you're essentially saying, we expect not to get some of our receivables, that wealth has to disappear off your books, and it's erased using the bad debt expense account. So let's go to exercise 25 to practice a couple of these. Actually, you know what? I should go over supplies because it's in exercise 25 too. Supplies is pretty straightforward. All you're actually trying to do, and it's not just supplies, it's any account that is periodically updated. So for instance, if you actually go into the storeroom and grab, say, where you keep your office supplies, and you grab a pencil, and then technically, and you take it out and you use it, technically that's consumption, and there should be a journal entry for that, right? But that's ridiculous. A 5-cent journal entry for every time you get an eraser or a sheet of paper and put it in the printer. that doesn't happen, right? So what happens is you just use supplies as the days go by. And then when it comes time, when the end of the accounting period gets close, you go and you do a little inventory count and estimate how much is left. And then you make a single adjustment to update the balance of the supplies account to what you actually have on hand, right? And supplies or any other account that is periodically updated. So now let's go to exercise 25 and try some examples. So here we are, and this learning activity for adjustment should look pretty similar to the others. So rather than explain it, I'll just start. So when you read this, there's quite a bit of information. And what you have to understand is that the only thing that would generate bad debt is sales on credit. People who buy stuff from you with cash aren't going to not pay you because they already have, right? So what you want to figure out is, what is my net sales after on credit, after all deductions and everything? In other words, what is the total amount of sales on credit? So in this example, they tell you you've had 300,000 of sales total, but only 180,000 of them are on credit. And then it also tells you that of all these sales, 40,000 were returned, sales returned. So customers bought stuff and decided they didn't want it. And of those, 10,000 of the returns were credit sales. So what you actually care about then is the $180,000 of total credit sales minus the $10,000 of credit sales that were returned and therefore didn't have to be paid, which of course equals what's called net credit sales, right? Net in business means there's been a calculation to come up with the net or final value. And the net credit sales is 170, and that's the number we care about, because since that's the total amount of credit sales that happened and remained, that's how much we should be collecting on accounts receivable over the course of the year, right? That's what this year's revenue would generate in accounts receivable, $170,000 of receivables at one point or another. So because of historical, patterns, this business knows that about 3.5% of these 170,000 go bad, that we don't collect them. So if we read this, it's asking us to make a single entry for the net credit sales owing for the whole year on December 31st. That wouldn't really happen, but we want to throw in the balance for accounts receivable just so we can see it right here where we show the balance sheet. So we'll do that. So we'll go December 31st of this year, and we go accounts receivable to show what we're owed in total, imagining that we do this entry all at once, which we of course would not, and we will credit our sales for revenue, which is 170,000. So now at December 31st on our balance sheet, the little snippet, we see accounts receivable is 170. And this is why, according to the purpose of accounting, this is not useful information. It's misleading. So it's not conservative, and it violates the expense principle, this idea that all the expenses from this year, this accounting period, need to be in the books and recorded and shown. And they're not, because some of this is going to be bad debt. People aren't going to pay us. So what we have to do also on December 31st is we have to make an allowance. That is step one. So we go bad debt expense, and that's going to be the 170,000 times 3.5%, because historically that's what we've had as bad debt, and that as a decimal is 0.035, and that works out to be 59.50. And we will credit the allowance for doubtful accounts the same amount, just like that. So I'm going to write down here that this is step. It might not let me actually. This is step one, like that. I might even write it up here. Right, and now we'll take a quick little look at the balance sheet. So we have what we're legally owed and what the allowance is, and this is the book value or net realizable value of accounts receivable. That's what we are saying we expect to get. And so when a user of the financial statements looks, they'll say, oh yeah, they got some bad debt. This is what I can expect. And also it applies when they do analysis, right? When you do financial analysis. You don't want to use this number for your quick ratio or your current ratio or things that use the value of current assets, because you're not going to get all of it. You need to use this value. It's more realistic. It's better for planning and analysis as well. So the last step, now I want you to take a look at this number, $164,050. I've told you that bad debt, let's go back to the top real quick. Bad debt is a two-step process. This is why. So on a written quiz about adjustments, this would be something I'd ask. It's a two-step process. I'm going to copy this number and I'm just going to put it, where can I put it? We'll put it right here for now. Okay, nice and big. Step 2, it says at the end of May the following year, we'll write off the bad debt from this year's adjustment. That's step 2. Write-off is step 2, right? So removing the accounts receivable is also called writing it off, so a write-off. And making the allowance is when you make the expense. So watch what happens at the end of May in the previous year, or sorry, in the next year, as it says, when we write this off. So what you will do is you will debit the allowance for doubtful accounts associated with the receivables you're writing off, and you will erase that accounts receivable. And it's often not a specific account receivable. It's just a value of accounts receivables, right? When you make the allowance, it's not necessarily any account or customer in particular, but when you write off a particular account receivable, it is specific. So you almost never get your allowance to be back to zero. It just kind of is always fluctuating. So allowance, it's this number again. So we're going to wipe out the allowance. As you know, see here, it's gone. And then we're also going to wipe out that account receivable of the same value. Now something has happened here. This is step 2. I'll even write it. So this is step 2. Take a look here. What is our book value or net realizable value of accounts receivable? Our accounts receivable now is $164,050 with no allowance for a total of this, which is the same as this number I put up here. So what happened then to this total because of step 2? Well, I'll tell you what happened. Nothing. Right? Take a look at these journal entries. This is a contra asset. This is an asset. They wipe each other out and have no effect on assets. Guess what else they are? They're not expense or revenue accounts. So step 2 has no impact on the financial statements whatsoever, which means you can do step 2 30 years later if you want to. That's why there's 2 steps. Because of the revenue recognition, or in this case, the expense or matching principle, and because of the principle of conservatism, the minute you think there's a possibility you might have bad debt, you record it in that accounting period with step 1. And then when you're sure someone won't pay, you do step 2. And it doesn't necessarily matter when you eventually get around to deciding to do step 2 because it has no impact on the financial statements. So let's move on to supplies. So if you recall, supplies, we go back to the top. Supplies is essentially this notion that, so if we look down this little example in our larger, more comprehensive note, we've got supplies on the 1st of January, $1,500. We bought some more on April 10th, bought some more on September 19th, and the grand total's $3,000. That's what would be in the account. And because when someone goes to get an eraser out of the storeroom, you don't make a journal entry, that's not what you're going to have left. So if you only have, well, in the example right here, it says they have $1,200 left, then you have to make sure there's $1,200 left in the account, which means the expense is going to be $1,800. $1,800's been used up over the course of the year based on what should be in there. So when you go to do the adjustment, $3,000 will actually be in the supplies account, but your inventory account will show you only have $1,200. And so you need to bring it down from $3,000 to $1,200 with an expense of $1,800. That's it. That's really all there is to it. So in this example, on December 31st of this year, the supplies account has a final balance of $2,375. But that's the result of an entire year of buying or having supplies and taking nothing out of that account. And generally, there's a few jurisdictions, I think Canada as well, where you don't do this anymore. The minute you buy supplies, you expense them because they're not worth very much. And trying to worry about this process is essentially, it's not worth the time. So usually things like sundries and miscellaneous, the small things and supplies are just, I think, written off the minute you buy them. Anyway, so periodically maintained accounts, though, this is the way you do it. On December 31st of this year, the supplies account had this much in it, which means anything that was bought, all of that, it was just added to this account. So an inventory account at the end of the year came up with an estimate of only $950 left. So that's what needs to be in the account on the balance sheet. So in the account at the very end of the year, because that's what we have on hand. That's our asset of supplies. So how do we do this? Well, December 31st is our adjustment date. And this is quite simply, if we had 2375 and we subtract 950, that means 1425 is the difference. So 1425 must be what was used up. So we would go supplies expense to show the usage, right? 1425. And as you can see in the supplies account, this value is what we had at the beginning of the year plus any purchases, right? And then we credit that usage out of the short-term asset, the current asset, the supplies account. So 1425. And as you can see, now that we started with 2375 and we've credited 1425, the balance in the account is 950, which on our balance sheet at December 31st is what we want to show, and that's what's there. That's all there is to it.